Us, Jayesh. Good morning. What do you think would happen to rates or bonds and currencies till the budget? Do you think it will be vulnerable? It will be very volatile going into such big events?
Yeah, it's more than local event. I think it's a global event and global uncertainty which will keep the yield going down in check. Because as of right now, from a local perspective, yes, people would expect no fiscal slippage in the budget, and people are expecting maybe a 0.25% cut in February policy post-budget if the budget happens on 1st February. So I think from a local perspective, definitely yields are looking to move down. But at the same time, what's happening is U.S. yields, of course, today is much better. But if you look at it from November, December till I think February, March, it actually is trading more on expectation and sentiments, which is where the new president will put in the priming, that is government spending and lower taxation and therefore wider fiscal deficit and therefore higher rates. So that's something we will come to know only by maybe mid-February or so. So it's going to be a little tricky. Till that time, the market is going to trade more on sentiment. So can it go to 230, 225? Yes, it can. Can it go to 275, 280? Yes, it can. So while it swings in that range, it becomes really difficult to trade not only India but any other emerging market when U.S. gets strengthened, particularly U.S. yields harden up and U.S. Currency gets strengthened. So I think both the things put together is putting a little bit vulnerability. So we'll see some volatility. Otherwise, if you look at India macro, there cannot be any better macro for bond market currently than what we have. So from that perspective, yes, the yield going down in a hurry is getting kind of stalled.
Say if yields go down and yields into US remain stable or slightly higher, do you think it can lead to a big outflow from FIIs?
See, if you really look at it from a debt FI perspective, unlike every other emerging market, we have very restrictive debt inflows, right? So and I think a lot of them actually, before the U.S. election and all that, a lot of them have actually captured and booked profit, right? So if you really look at it from a FPI perspective and debt side, that's very nominal, I would say, foreigner investment, maybe even 1.5–2% kind of thing of the total outstanding. So it's to an extent, it's not too material at this juncture. But if U.S. yield goes up more than that, I would worry about the equity, though we had enough outflow of equity. But if equity outflow continues, that can put pressure on overall Indian currency and stuff like that. And that would kind of, stop the yield going down further on the bond side. And of course, if the currency gets under pressure, it's very difficult for central bank also to cut rate and stuff. So that's where the worry is. So unlike other emerging market, we are not too worried about if US yield goes up and then FI debt goes out. But FI debt's not really there at large juncture at this moment.
Dollar index has corrected in the last 2 days. Do you think it will continue to show strength or the trajectory that it was? What is your view on dollar index? Okay, I think we have some network issues with that link. We'll just get that up. But meanwhile, Nifty has corrected. So we were up 10 points earlier. Now it's just blinking into the green. It may anytime slip into the red if it has to, or if there is further selling. So it's okay. It's now absolutely flat. There is really no change, and it has gone into the red right now. 8,273, 8,270, I think, was the pivot for the day. So it should take some support over there. but if it breaks, then it could be a problem. Okay, Jayesh Mehta is back with us. Jayesh, could you just start again? What is your view on the dollar index?
Yeah, so dollar index again is the same thing with the sentiment. It's more moving with expectation of U.S. Spending and U.S. infra spending and tax cut. But infra spending, tax cut, yield going higher, and therefore also dollar index should also go higher. But of course, as you see, like 10-year yield moved from 265 to 230. That's corrected a bit. The same thing is also happening on the dollar index. But as I said, like right now, it's not going purely on any fundamental or any news. It's actually going on expectation that what the new president will do. And what the new president will do, we will come to know only by mid-Feb or so. So till that time, when the market is trading on expectation, it can really swing either way, and then you have correction, and then you have again bounce back. So it's really little difficult to pinpoint out where it will settle down till you get to know the whole picture, the new government there and their plans and their ideas and stuff like that.
Jayesh, if you could just talk about how global flows can react. How do you think global markets will react till the time this uncertainty goes away?
Yeah, because global market will react with all emerging market till the uncertainty is there, and it would be very difficult to pinpoint out a number. So right now the range is very wide. Say if you look at 10 years, the expectation range is anywhere between 230 to 280 or so, and you will not come to know the real picture where it will settle down, and so it will definitely, if it strengthens, it will definitely impact all the emerging market. But as I was telling earlier, that unlike 2013, where we were most vulnerable, this time around, I think we are most comfortably placed. So yes, if it strengthens too much, we might get hurt, but not as compared to the way the other emerging market would get hurt. So from that perspective, I think we are much better positioned than what we were in 2013. But whether that impact really happens or not, only will come to know by February, March. So till that time, we will have to live with some volatility. There will be bouts where you will have suddenly everything booming, bonds appreciating, equities doing great, and then you will be having bouts where there will be sell-off. So both ways it will move depending on how US moves for next 2 months.
In terms of flows that we've seen so far, emerging markets have seen outflow and developed markets have seen inflow. Do you think that will continue?
That's, again, as I said, like it's all on expectation. They are, of course, it did, and that's where we see the correction, right? So if you look at US yields, which went to maybe 270, 265 or so, that was attractive for a lot of investors to move money out of emerging market and moving to the developed market, and particularly US and other developed markets. But maybe now it's again softened down. We might see a bout of it going back again. But that kind of situation will continue for some time until it settles down. If it settles at naturally 260 plus or 270 plus, definitely the flows will further move out because that will look more attractive than emerging market. But that's a big but. Of course, the street expectation is also very wide. There are people who are expecting 3 plus or maybe 3/4. So it depends on what camp you are, but it's all expectation. There is no fundamental news as of right now.
So let's talk about what's happening into India. We've seen a very big rate cut from SBI, 90 basis points. It's one of the largest that you've seen in a while. Do you think the corporate bond market, which was increasing the market share versus the banks, do you think that will have a big impact by this rate cut?
Not really, because if you really look at it, corporate bond market, of course, it will definitely benefit. But if you really look at it at this juncture, we are going through the cycle, right, where GSEC yields also post demonetization really came down dramatically, and the same happened to the corporate bond market too, right? And now, in last few days, it has gone up, particularly after the policy from December onwards, it's gone up. Gone up by almost like 10 years has gone up to 6.5 or so, 660 or so, and that was happened also on the corporate bond side. And from effective 1st January, there has been some buying happening. It went down to a low of 635 or so, 32 or so, and now it's back to 637, 38. But yes, bank's rate cut. So that bank's rate cut didn't match the falling yield which happened in last 6 months. Not only, so that is just more of a correction there happening, and that is more of a liquidity phenomena rather than anything else. Earlier, while we were having rate cuts, so we were not having surplus liquidity. Now, of course, July onwards, we have been infusing liquidity, and now, of course, because of demonetization, there had been pretty good liquidity. Of course, I personally don't think this liquidity will last for long, because at the end of the day, RBI through MSS or other things would keep the system in a surplus mode, but not to the extent of, say, which is today is like 2 lakh crore or so. It would be maybe 70, 80,000, maybe 1 lakh crore or so. But that would be good for overall market. That will bring down deposit. That's already brought down deposit rate. Now the lending rates have come down, and once we see some stability on the global front side, I'm quite optimistic that we'll see pretty good, reduction in bond as well as government bond as well as corporate bond yield.
As far as the overall liquidity picture is concerned, even if the withdrawals that you are factoring in, or the sort of withdrawals that may happen, it may not have a big impact on liquidity because the credit demand itself has gone down.
There are two parts. The credit demand would still keep the liquidity in the system. I think withdrawals, if you really look at, I'm looking at big numbers, what's been announced, pre-demonetization, we had 17.25 lakh crores, including 100 notes and all that put together. Till now, roughly around, new notes coming in and old notes going out, that 17.25 has kind of become 9.25 or so, the difference of almost like 8 lakh crore. But, that 8 lakh crore, 9.25, maybe another lakh or two withdrawal, maybe once we reach a total currency in circulation 11.5, which is good enough for overall, macroeconomy or microeconomy. That should be good enough. We don't expect the entire 17.25 going back into the currency in circulation. So from that perspective, that will remain. Now, when that remains on the banking system as surplus, but that doesn't mean central bank will keep that much surplus in the system. So, of course, you have 6 lakh crores limit of MSS, and, of course, you can always do reverse repo. Reverse repo, of course, will have temporary overnight impact, but, it depends on MSS and how long the MSS and how much it's being sucked out. So I think RBI will also calibrate once they come to know what kind of withdrawal, and then it's stagnating around that, and then that's when they will kind of figure it out, what is the surplus they need to suck it out for slightly longer tenor.
But do you think credit growth has to pick up? Because, just lowering rates may not see a major pickup in credit growth. So credit growth, the need for credit has to pick up. That will be the trigger, as when the banks could do well or bond markets could do well.
Not really. In fact, bond market, if the credit growth does not happen, that's good for the bond market. But if the credit growth start picking up, doesn't look like immediately, particularly on the capex side. Maybe some, swaps here and there, and some retail credit growth might happen. But beyond that, we are not hearing any large credit coming up in next 2-3 months, or maybe next next quarter or so. So to that extent, credit growth will remain subdued. And that's we are seeing it, right? Like, is there really any new demand for credit really coming up? That's the big challenge, right? We're not even hearing anything new projects on the private sector side. Of course, government spend is definitely keeping the economy in shape, and that should continue. So, but on the private side, we really haven't seen any much large demand across the board.
In terms of currency and the performance
CapEx.
in terms of currency and the performance that India has shown versus some of the other emerging markets, can there be a problem for exports growth only particularly for India?
I'm slightly of the different camp. Like, I don't really see, our export really struggling if our currency is appreciating, because you look at our large part of export is software. That's not that price sensitive. It is, but it is not that price sensitive, and it's not everything is commoditized. On the part, definitely you will have your currency is not depreciated as compared to others, and therefore you will get impacted. But I don't think in our overall basket we should be that much bothered. But of course, there is a whole lot of views everybody has. Some people say that if you don't have currency depreciation and therefore export struggles, and some people are like me saying that no, it really does not. So, but it's ultimately what is the call the regulators take. It depends on them, but everybody has different views there.
Right. Okay. Then let's talk about the currencies and the overall space. Do you think emerging markets currencies can be under pressure in 2017 also, and India, can remain or outperform within that basket?
Yes, that's what I said earlier. It's like if the US yield goes up, it remains 3 plus. Definitely, emerging market currency would be under pressure. That's the dollar strengthening and dollar index strengthening. But that is the expectation as of right now, that will go to 3.75. I am not of that camp, but as again, there's no fundamental views one can take. So it's like, you may say it may go to 3.75. I may say it may not go to 3.75 and it may remain at 2.25. But we both will actually know more on a fundamental, more on a known studied basis only once the new government, US government policy comes out and stuff like that. So till that time, is going to be anybody's pick, anybody's choice, and it's going to swing either way. So that's where I think till that time it can really swing between 2.25 to 2.75 either side. But where it sticks and remains sticky there, it's really difficult to say at this juncture. But so if it does not go beyond 2.5 and remain sticky below 2.5 for a sustainable period, once we come to know the policies there, then I think emerging market, particularly all the emerging market equities, and which should really see some great inflows coming in most of the places.
Just a last word on budget expectations. Say if it's slightly expansionary than what the street is expecting or what economists are building in, do you expect currency and bond markets to react quite sharply to that?
Yes, if it is expansionary, it would. But there was some talk, some media report, I don't know, it might require some regulatory change that because the entire impact of demonetization and all that, if the budget comes on 1st February, would be really difficult to see the benefit of that in terms of revenue or assess that in terms of revenue. And there was this news flash somewhere 5 days back that they may, keep the fiscal in control, but they may use for short-term measures. They may still use the MSS as like extra T-bills for government borrowing. So if that happens, the fiscal will remain controlled and contained, and that should not be the expectation of the market. Does not remain contained, and if it goes even by 0.2, 0.3 basis point, it will definitely impact the sentiment of the bond market. Though in material term size, 0.2, 0.3 should not really matter, but it will definitely impact the sentiment and the mood on the bond market. Thanks.
Mr. Mehta, thank you so much for taking out time for us. Always a pleasure.